Hi, this is Jim Cunningham, and today we're going to talk about critical asset protection and income tax reduction strategies for business owners. I view reducing taxes as an asset protection device because, if you have to pay money to the government, those are your assets, and that's going out of your checkbook and out to the government. So, disclaimer: I'm a lawyer. I am going to talk about a whole bunch of stuff, and this is not legal advice. In other words, don't watch this and go out and do a bunch of stuff without getting legal advice. So this is information only. If you're watching this on YouTube, we are recording this live on a webinar format. If you're watching this on YouTube, go ahead and you can post a question in the comment section. If you're watching this live, of course, you can put your question in the Q&A button because it's a webinar, not just the chat button, but the Q&A button. So we have offices in Northern and Southern California. We have a team currently of 8 lawyers. We're devoted exclusively to trust and estate matters and tax planning matters. I'm the CEO and partner at Cunningham Legal, and 25 years experience. Really, it's 27, but I think once you have more than 25 years experience, you just kind of say more than 25. Otherwise, you start looking kind of old. We help clients in Missouri, Texas, Virginia, Washington, state of Washington, and District of Columbia. And I'm a certified specialist in estate planning. And this is really, really important because when you hire an attorney to do estate planning, this is definitely the purview of specialists. And one of the things I've done is I've written a book, which you can get off our website, and it's Savvy Estate Planning: What You Need to Know Before You Hire the Right Lawyer. This is before you even go to the attorney's office. It's a great kind of bunch of stories, not a bunch of boring legal jargon. I'm also a real estate broker, securities insurance licensed, and a pilot, single engine land. So critical asset protection 101 for business owners. How can you structure ownership of your business, of your assets, in a way to protect yourself from creditors? Now, I'm not talking about evading creditors, but stuff happens in a business. Employees do crazy things, and you are liable for what your employees do. What I'm talking about is containing the liability, right? And not having that spread to the rest of your assets, and then having all of your assets, go to because an employee did something that was kind of bonehead, right? That generated a liability. So we're going to talk about structuring ownership of real property and dividing the real property, real estate, from the operating business. And there's some reasons why you might want to do that. Does it make sense to own a building and lease it back? And so what I'm talking about is if you're an owner user, if you buy a piece of commercial property and you lease that, should you have that in your own name? Should it be in an LLC? We're going to talk about that. We'll also talk about the Wyoming Close LLC and if it's a good fit for you. And for California residents, this is just a great asset protection feature, which is the California Private Retirement Plan. We'll cover that briefly toward the end. So what is a business? So this is interesting because it's essentially some type of organization or enterprise engaged in commercial, industrial, or professional activities. What does that mean? Well, it could be, a lawyer, a law firm is a business, a medical practice is a business. If you manufacture widgets, right, or stuff, that's a business. Also, owning rental properties is also a business. And so for many of our clients, they have a pretty significant portfolio of real estate. I would consider that a business. And as we go through, you'll see why you really do want to think about that as a business. You're engaged in the production of goods and services. They can be for-profit or not-for-profit. We're really focusing on for-profit. Not-for-profit does not pay taxes, and we're going to be talking a lot about taxes. And, obviously, they come in big and small sizes, and really it's any activity, any for-profit activity. And in the elements of a business, this is just sort of get your mind in the right mindset of what we're going to be talking about today. This kind of goes back to the Adam Smith sort of classical economist: land, labor, and capital. Land, you could replace with a server, right? An online server. For those of you who are working at home, you don't necessarily have to have land, but you obviously need to occupy a physical space in order to do work. And labor, this is really, really important. Labor laws in California, and I'm based in California, so I kind of have my California glasses on, if you will. Workers have really significant protection in the state of California, and employers sometimes just step in it. Employers, they say, well, this makes sense. Why can't I do it this particular way? But what you may find is the way you're doing it can expose you to liability, and a pretty significant liability. And, capital, land, labor, capital, those are kind of the elements of a business. So there are really 3 elements in planning. So when I meet with a client, And we talk about business planning. We talk about the structure of the ownership of the assets. How do you take title to assets? What entities are you using? And when I use the term entity, that means an LLC, corporation, partnership. How you take title to assets is extremely important. And taxes. I want to make this clear. We are not talking here, we're talking about minimizing taxes, but essentially this is basic tax hygiene. This is like doing things in a certain order that reduce your overall tax bill. You know, one of them is pay your taxes on time, especially your state income taxes, because if you don't pay your tax on time, if you're not paying your estimated taxes, you're going to have penalties and interest. And on the state side, they can be pretty severe. So again, this is not gimmicky. It's not a tax dodge. Also, your A team, consider assembling your A team to maximize, this is to maximize what you're doing. This is not a do-it-yourself project. You do need the lawyer, the CPA, the financial advisor. Those three people do need to be on your A team. And here's an example of an A team. This is the A team from the 80s, right? And not the newer A team, but this is what I mean by the A team. And you'll see here, there's me, right? I'm part of the A team with my book. So those people obviously are not on the A team that we work with because they're actors, but we do, those people would be financial advisors and CPAs that we work with when we're working with a client. Another way to remember this is taxes, A team, and ownership, and the Chinese philosophy of Tao. So it's just a way to remember what it is we're talking about. So Tao for our purposes here means taxes, A team, and ownership. So we're going to, we have a question here in the Q&A, and I'll take that. If you guys have a question, put it in the Q&A. Anonymous asks, I am building an in-law and will rent it out since it is not separate from my main house, now under my name and later my living trust to be formed. How do I protect myself? Oh, great question. So that's an interesting, the ADU, that's a single parcel. Boy, that one kind of stumped me. Perhaps you could structure a lease to a third-party company, a ground lease. And, but that's something, you know what, that actually is a great topic for a future webinar. So what you could do is lease that out to an entity such as an LLC and have the LLC rent the property out. The problem is you're living on the property. You're always responsible for your own negligence. So let's look at ownership structure. Let's take Owen. And in law school, they use words like Owen, meaning owner, because Owen sounds a lot like owner. So Owen is the owner of a McDonald's franchise, as well as the land and the building that the McDonald's occupies. Now, I don't happen to be a fan of McDonald's. I'm just using an example that everyone immediately goes, oh, I drive around and I see a McDonald's. So I understand what you're talking about. So after meeting with the A team, Owen's team creates several different structures. And I'm going to kind of walk you through why we create these and how they work. So an LLC owns the land and the building. So an LLC will own the dirt. It will own the structure in this particular case. And Owen creates a corporation to run his business, the day-to-day business. So the LLC, which is a term that means limited liability company, that will own the land, that will own the property. Owen's corporation that runs the business, making burgers and serving customers and handling employees, that corporation will rent the property from Owen's LLC. Now you might think, that just sounds like make work. Why are you doing that? Why are you breaking this up? And as we go through, you'll see why we do that. And then Owen also creates a holding company to hold the shares of the LLC and the corporation in a way that is protected from creditors. And so we'll finish up with that at the end. So Owen's Living Trust then in turn owns the shares of the holding company. So just bear with me on this. This may be kind of confusing, but I'm going to go through the example. And I think when we're done here, you'll have a much better handle on what I'm talking about. So why is it so complicated? You know, doesn't this just benefit lawyers and CPAs? Isn't this a lot of make work? You're going to see that Owen is going to save about $76,000 a year in income tax and potentially even more. So as we go through this, please pay attention. So how do you put property into an LLC? Well, if Owen owns the land in his own name or his living trust or whatever it is, he deeds that property to an LLC. Now, most lawyers, if you own a property at 123 Main Street, the name of the LLC will be 123 Main LLC or 123 Main Street LLC. It just kind of makes sense. So when you look at that, at the LLC, you go, oh yeah, that property owns 123 Main Street. So Owen, in exchange for putting the property into the LLC, Owen gets membership units or shares, and you can call them whatever you want, but membership units for our purposes here. Owen gets membership units in return. So Owen deeds the property to the LLC, and in return, now Owen holds LLC shares and the LLC owns the property. So that ownership is just kind of one step away from Owen. And then Owen's McDonald's Corporation, as you'll see, his franchise, the corporation that we set up for him, pays rent to the LLC. Now you may think, well, that's kind of circular, but as we go through this, you'll see how Owen will pay less tax. So it's really important creating an LLC rather than Owen owning the franchise in his own name and owning the property in his own name or his living trust. Okay. There's no separation of liability. So if something goes wrong, Owen's personal assets are obligated to pay whatever, lawsuit or judgment or whatever, whatever happens in there. So what we're talking about here is containing inside liability. For example, if a fire starts on this McDonald's and spreads to other parcels, and this happened, we're in California, we're coming up on fire season here. We're in July of 2022. That fire starts at the McDonald's and maybe it spreads to a couple other structures and burns those structures down. Owen, if he owns that property individually, he's personally liable for that because he's the owner of the property. It starts on the property. He's going to have responsibility for that. If it's in an LLC, the liability is contained in the LLC. And really the only thing that a creditor can get is the land and the building. So not Owen's personal assets. So this is an asset protection strategy in the sense of limiting the inside liability. Okay. So there's inside and there's outside liability. Okay. So again, only the assets of the LLC can be used to satisfy the claim. Something to understand is people say, and I get this a lot, and if we get a lot of attorneys and accountants watching this, I hear this a lot from accountants, less so from lawyers. They say, oh, well, just get insurance. But what I said is that fire starts in the building and spreads to other parcels. That could be tens of millions of dollars in damage. And Owen may not have enough insurance. His insurance may not cover other structures. Who knows? So there are some constraints on insurance in the sense that it's constrained by the amount of coverage, meaning your damages can be greater than the coverage. It's also constrained in time. It's every year and you might, get canceled or lose your insurance. And then there's also a coverage issue. Certain things are not covered. And we'll go through that when we talk about the corporation. So financing, this is kind of interesting on the LLC. Owen, maybe the LLC goes out and borrows money. Most banks are going to require a personal guarantee from Owen, but sometimes they don't. So it just depends on the bank that you go with. And if Owen sells a McDonald's franchise, he still gets the rents. So if he's teeing this up to have to own the property, it's clean, it's separate, it's showing on the books on the McDonald's franchise that he's paying this rent. Maybe a new franchisee comes in and buys out the franchise, and Owen just sits back and goes fishing and collects rents as a landlord. And then we're going to talk about taxes. So we do have a question here, and feel free to ask questions as we go along. Is there a liability issue if the LLC is a single member LLC? That there might be, Russell. That's a great question. Again, you're always responsible for your own negligence, but I would say, generally speaking, even if it's a single member LLC, that asset is going to be contained or confined to the LLC unless Owen was the bad actor. But if Owen's sitting back and he's got a manager at the McDonald's and, they start a fire at the structure and it spreads, he doesn't have personal liability. Owen has a really good argument that the liability should be contained in the LLC. So versus not having it in the LLC and he's just on the hook. So don't forget taxes. So an LLC is kind of an in between a corporation and a partnership. All corporations are taxed as corporations, meaning they're taxed as a C corporation or an S corporation. And there's a whole body of law on that. All partnerships are taxed as a partnership, meaning you have to file a partnership return. An LLC can be taxed as a corporation, be taxed as a partnership, and also be taxed as a disregarded entity. What a disregarded entity means is you don't file a separate federal return, you file a state return, but all the information that's reported to the federal government is reported on your own 1040. So that's what a disregarded entity means. Owen can adjust the amount of rent that he pays to his LLC, to his disregarded entity, to optimize tax benefits. And as we go through this, you're going to see what I'm talking about. So tax benefits of a partnership or disregarded entity versus a corporation, you get an adjusted cost basis on the underlying asset in the partnership or the disregarded entity. A little bit of asterisk on the disregarded entity, you get adjusted cost basis on your shares, but just go with me on this. You get an adjusted cost basis. You do not get an adjusted cost basis if it's a corporation on the underlying asset. You have a higher basis on your shares. Capital gains tax treatment on sale, that's very important. It's not taxable as income. It allows you to reduce federal and state income taxes, and I'm going to show you how that works. So this is really, really big. And for those of you who are business owners, if your CPA did not reach out to you last year or this year before June 15th to tell you to have your entity pay a bunch of state income tax, and you'll know because you're like, why do I have to pay so much state income tax? You might need a new CPA. So this is AB 150. This was a bill that was passed to address the SALT cap, the state and local tax, SALT, state and local tax cap. So without any entities, if Owen is just a sole proprietor, he owns everything in his own name, his income tax bill, state income tax bill in California. Now, if you're not in California, this is one reason people leave, $106,870. He can only deduct $10,000 off his federal return. The rest of that is not deductible since 2017, is no longer deductible on his income tax or on his federal income tax return. Okay, under AB 150, this is Assembly Bill 150 for tax years 2021 through 2025, because that's when the SALT cap expires in 2026. You can pay those state income taxes from the entity and get a federal deduction. So let me say this another way. You have an entity like an LLC or a partnership or a corporation, even a disregarded entity. Normally, you individually pay those income taxes because those are passed through or flow through entities, meaning a partnership doesn't really pay taxes. The partners pay taxes on distributions. But what the state did is they rewrote the law. And what they said is your entity, your partnership, your corporation, your disregarded entity can pay those taxes, and you get a federal deduction for that. So this is a really, really big deal. So if you're paying $100,000 a year in state income tax, this is a really big deal. If you're not doing this, this is something that you really should immediately get on and make sure you've got all your paperwork, all your stuff together, right, with your A team. That's why I mentioned the A team, because this really isn't a do-it-yourself project. So if Owen pays the franchise tax board from the LLC, his total tax bill will be $90,000. That saves $16,867. That's a lot of money. That's just by paying it differently rather than waiting or rather than paying it individually, paying it on the corporate level. And then he deducts $83,700 of that. And the reason it's different is because he's also taking a $100,000 salary in a later example. But Owen saves another almost $31,000 in federal income tax. That's what FIT means, federal income tax. So this is maybe a little complicated, but understand this is one really big reason through 2025 to organize as an entity, because you will pay less tax. Okay, that is kind of the messaging here. So let's talk about the operating of the McDonald's franchise. So Owen employs a lot of people. For those of you who own franchise, fast food restaurants, a lot of time you're hiring a lot of people. A lot of people are quitting. You have typically a lot of turnover. There are a lot of labor law rules in California, a lot of potential liability. And if you make one mistake on a pay stub, again, it's a recurring mistake probably, but I do know a person who basically went bankrupt because they put the compensation in the wrong box. So the people paid what they were paid what they should have been paid, but because it was put in the wrong box, they got a plaintiff's lawyer who sued the business owner, and the business owner went bankrupt because it was like a $4 million judgment. So pretty scary stuff. You really need to pay attention to labor law in California. If you are a business owner in California and have employees and you do not have a labor law attorney on speed dial, you need one. That's part of your A team. Okay, we don't do labor law in our firm, but that's something you really do need to pay attention to. It's also a common source of uninsured or uninsurable liability. So, if you mess up on the pay, there's really no insurance for that. Okay, that's a real problem. So these are things that aren't covered by insurance. So instead of operating as a sole proprietorship, Owen creates a corporation. In this case, it's an S corporation. There's a C corporation, like Apple is a C corporation, big old company, right? They pay dividends and they pay corporate tax. Maybe not enough. I don't know, depending on your point of view, but they pay corporate tax, and then they turn around and you pay tax on the dividend that you get from from Apple. That's a C corporation, as in Charlie. S corporation is in Sierra. An S corporation is slightly different. That's where the corporation does not pay any tax on the corporate level. And that flows through, kind of like I mentioned, the partnership that flows through to the individual shareholder. So there are two really good reasons to have an S corporation versus a sole proprietorship in this case. It is to contain the inside liability. So it's very, very important. You want to contain that liability. So we see a lot of labor law violations, quite frankly, wage and hour, meal break, that sort of thing. Those can be certified as a class action, and they really can wreak havoc on a business owner, especially if you don't have a corporation set up, right? If you're personally liable on everything, it's you. And, it can be really stressful for people when they're going through that because it's very uncertain. And again, your reduction in your overall tax bill. And I'll show you how this works. So Owen creates Owen Inc. to employ the staff and operate the business. He takes a salary of $100,000 a year. He's going to pay tax on that salary. And he's an employee owner of Owen Inc. The $900,000 in profit. Now, in this case, he's making $1 million a year. And by the way, for those of you who might own a McDonald's franchise or wondering, you don't make $1 million a year on a McDonald's franchise. This is just an example. So, and $1 million is a nice round number. So it made my math easier. And it's also easier to kind of understand the percentages. But Owen takes a salary of $100,000. But California has this really weird rule. I said that S Corps don't pay tax, but they do pay tax. They pay 1.5% to the state of California on profits. So that $900,000 would result in a $13,500 bill. But what we're able to do is we're able to increase the rent. Okay. And we would do this on in the lease, that the rents would go up, right? If the profits go up, the rents go up to an entity that Owen owns. And so we bypass that 1.5% corporate tax because that increased rent is going to the LLC that owns the property. And that LLC does have a tax liability associated with it. It's called a gross receipts tax of about $2,500. So it is $2,500 in this case. And again, if you're not getting this, the point I want to make is if you're a business owner and you have a business and you own property and you have employees, you really do need an A-team to figure this stuff out because you can't figure this stuff out on your own. And these are tough cases. I will tell you, when I sit down with a client, I don't know everything. The CPA doesn't know everything. Financial advisor doesn't know everything. We come together as a team and we work together because we all have gaps in our knowledge, right? I have gaps in my knowledge. The other people on the A-team have gaps in their knowledge, but when we come together, we're able to serve the client much better than we would individually, or certainly the client, on his or her own. So Owen makes $1 million a year from his McDonald's. If he's not incorporated, not only does he pay state and federal tax, he's got to pay 2.9% on the $1 million on the Medicare tax. But if he takes a salary of $100,000, he saves $29,000 in Medicare tax. So if he's, rather than taking $1 million as comp, and I do see clients come in, they have, because they want to avoid the 1.5% tax on an S Corp, they end up taking as compensation all of their profits. Look at another structure, because that's really just not an efficient structure. So by taking a salary and taking the rest as dividends, then, or shifting it to rent, he's going to pay $29,000 less. Owen's going to pay $29,000 less in tax. And the grand total is $76,743. This is why Owen set up an LLC and a corporation, because he's paying less income tax. Folks, this is every year. Every year, he's going to pay $76,000 less. So this is what the structure looks like. On the left-hand side, we've got the S Corp operating the business. Owen's Trust owns the shares of the S Corp for now. We're going to revisit this in a few slides. Owen takes $100,000 salary, and then Owen shifts the profits from the S Corp over, and this is lawful. This is not illegal, okay? Because you are lawfully paying the tax. You're either going to pay 1.5% tax on the profits, or you're going to pay a $2,500 gross receipts tax on the LLC side. So Owen's able to move those profits into the LLC and save over $10,000 in corporate taxes in the state of California. And so you can see here, the total is $76,000. So quite a savings. And again, that's every year. Think about how much money you would have to have in the bank to get a $76,000 return. So Anonymous asked, parents have a commercial building in an S Corp with a very low basis because they were duped into buying S Corp stock versus the asset in the S Corp. What will happen when the parents pass away and I inherit the S Corp? Well, Anonymous, I don't know. I don't know because it depends, which I hate to use the phrase that every other lawyer likes to use, but it depends. Here's a problem. That is something that you should assemble your A team and look at. Now, one benefit is it is possible that you will not be reassessed on that property. So if the property was reassessed when they acquired the S Corp, and again, as I'm talking, I would say this is something where you should probably just reach out to us and we go over that individually and we can tell you kind of where you're at right now, and what will happen if you don't do anything, and then maybe some alternatives. But that is a much more complex. It seems easy. Generally, you don't want to have a corporation owning real property for a lot of reasons, but in this case, it may be a good idea to keep it. But we would talk about that one-on-one. So we've got Owen saving $76,000 a year every year. But wait, there's more. It gets even better. We're not done. We're just getting started. There are some other strategies available to business owners that are income tax saving strategies, as well as asset protection strategies. So on our YouTube page, we have a lot of content on tax planning. This is not exhaustive. This is just kind of the tip of the iceberg, but these are the big ones. These are the big needle movers. These are the ones that typically don't take a lot of headspace. They don't take much commitment of capital in terms of other tax planning strategies that might be out there. So let's get to it. So what is a 401k? You guys have heard this. I'm not going to spend a whole lot of time on this. It's a defined contribution retirement savings plan. You put in 10,000 a year, whatever you put in, and then you separate from your company and you got $1 million in your 401k, and that's your retirement. It's just money, right? It's in an account, and you roll that over to an IRA, or you do whatever you're going to do. This is offered by many employers. If you are an employer and do not have a 401k, I would really encourage you to take a look at that because it is a really good retention strategy. Now we're going through a little bit of shift in the labor market as we're doing this, as we're recording this. It's July of 2022. And it's still a tight labor market. It's starting to loosen up. Some companies are laying people off, but the 401k is a great retention strategy. And it really, frankly, it helps people save for retirement, which is a good thing. And, you can, if you're the owner and an employee, you can participate in the 401k too. And so we'll go over some numbers here in another slide. And the 401k comes from the Internal Revenue Code section. That's where it gets its name. Who would make that up? It's terrible marketing. 401k. Employees can also, so here's how it works. Employees say, I'll put in 1, 2, 3, 4, 6%, whatever it is. It's a percentage of salary that goes in every pay period. And then the employers can match or not. In our firm, we match the 401k. Many other organizations don't. Many companies don't even have a 401k. And then the employees get to choose where they invest the money. So in our case, Owen, in his corporation, he sets up Owen Inc. and he's got these employees at McDonald's, and he sets up a 401k and matches contributions up to 4% per employee. That's not the maximum you can go, but that's what many people do. Owen can contribute, and this is really important. Anyone can contribute, including Owen, $61,000 a year. Now that is deducted. So this is a pre-tax contribution. So what that means is this is not just like the $6,000 IRA you're doing, but this is like a super IRA, right? Because you can put more money into it, and you can set it up as a Roth. You can set it up as a normal IRA. We have a lot of content on Roth IRAs and why that's a good idea. And if Owen's married, he and his spouse can save up to $121,000. If Owen's over 50, people who are over 50 can have what they call catch up and contribute $67,000. But if Owen puts in $61,000, he's saving $33,000 in tax. So in California, our marginal tax rate is over 50%. It's the weather tax, I suppose. But very, very important. This is a pre-tax contribution, so you pay less tax. So if you're saying, I know I need to do a 401k, I'm just not getting around to it, really take a look at this, because that's less money that's going out in tax that stays with you. Kelly says, do you have to offer the 401k plan to all employees, part-time, full-time, executives? Yeah, Kelly, this is why we have the A team. But my understanding, I think it's 1,000 hour or 500. There's some type of hourly requirement. You can also have a vesting period. I'm not a 401k expert. That I defer to the financial advisors and CPAs on that, but typically financial advisors. Of the 61,000, how much can be for a Roth? I believe the whole thing, if it's a Roth 401k, you just can't do matching Roth. So that's really important. So you can do your own, but again, 61,000, that's not deductible. But if you're making more than 160,000 a year, you're not going to be able to fund a Roth. So that's a good thing to look at. But again, I would go back, if you have a 401k, ask your administrator or the person who's helping you with that. Something else to be mindful of. It's really important to pay attention to the expenses on a 401k. And that's something where, certainly you can, we've done a lot of videos with a lot of different experts on our YouTube page. I would encourage you to take a look at that. But that really is something, because I believe they can go as high as 3%, which is a huge amount to pay. But we do see some of those coming kind of when clients come in and they bring in all their documents. Pay attention to expenses, because 3% is way too much. The solo 401k. So if you're watching this and you're a business owner and you say, look, I'm just a one-man band or a one-woman operation or an independent contractor or a freelancer, self-employed, you can do a solo 401k, same limit, 61,000 and 67,500. And you can do the Roth or the normal IRA. And that's just kind of a math function to figure out if you should be, if it makes sense to do it that way. Let's see. Backdoor and side door Roths are a great workaround to the income limitation. Randall, that's right. That's absolutely right. So what Randall's saying is, you can do your IRA, your 401k, and separate from your company, roll it over, and do a Roth conversion. We have a whole bunch of videos on Roth conversions, a whole bunch of content on our YouTube page, and I believe our website as well. So cash balance pension plan. So this is a defined benefit pension plan, and you do have an option of a lifetime annuity, and this is going to start sounding familiar. It's an old school pension plan. My grandfather worked at General Motors. He retired in 1973 and had a pension from General Motors, and passed away before GM went bankrupt. And thankfully, you didn't have to see that disaster. But these are the old school pension plans. So this is based on a percentage of pay. The rate of return and the risk is regulated. This is really important to understand, because people who have cash balance pension plans, they'll say, hey, my return was only 8% or my return was only 10%. And there's a reason for that. It can't be too high. It sounds crazy. And it also can't be too low. So it has to be a bracketed. And again, these are, I believe they're regulated by the Department of Labor, U.S. Department of Labor. So there's some rules that go in here, some constraints. And that's why I say, it works for some people, but not all business owners. And the stars kind of have to be aligned. You get the pyramids there. If the stars are aligned, it can be a fantastic strategy. We see this a lot with physicians who have either no employees or some employees. We see this a lot with people who are continuing to work without many employees, and they're kind of at the tail end of their professional life. And many times people make a lot more money at the end of their professional life. I know when my dad retired as a personal injury lawyer, he ended up pocketing more money because the cases were kind of over and his employee headcount went down, but the income still stayed high. So it's just the nature of personal injury that you get paid at the end of the matter. So that's what I'm saying. It can be a good fit. It can be not such a good fit. It just really depends. And that's why you really do need to talk to your A team. You need to get together with that group of people. So in this case, Owen, he can put up to $245,000 into a cash balance pension plan. That is a huge number. $245,000. That is the limit for 2022. That means it's deducted from Owen's income. So that saves him $121,000 in income tax. So if this is something where you're like, wow, that sounds kind of good. If you're a very high income earner, this may be for you. It may not be for you. I have no idea, right? But it's something certainly to take a look at. And if Owen's married, that amount can be doubled. So that could be a $240,000 savings. So a lot of, again, just works for some people, doesn't work for all people. The catch here, this is one reason why it doesn't work for everyone, is you also need to make contributions for employees. So it's helpful with retention. It can provide further tax savings. But again, some people, they go, I'll do the 401k and I'll do some other type of tax planning because I don't want to have to give that much to my employees. Other people say, I'm happy to give it to my employees. So it just depends on, it just depends on your individual situation. And then we'll finish it up with two asset protection strategies and we'll get to questions. One is a Wyoming Close LLC. And I kind of call this a poison pill strategy, where if a creditor is coming after you and you have this structure, they really think twice about seizing shares of this type of LLC, and I'll explain why. And the other one is a California private retirement plan, and that utilizes California law to protect assets set aside for retirement. So these are two different types of planning devices. Some clients use one, but not the other. Some clients choose to use both, and you'll see why. So let's talk about the Wyoming LLC. So Wyoming's got a lot going for it. When it comes to LLCs, it is very hard to beat. South Dakota is another jurisdiction. Delaware is another jurisdiction, but the Wyoming Close LLC, and it's not, if you're watching the video on this, it's not Close LLC, it's Close LLC. So close and close are spelled the same. Depending on the context, they're pronounced differently. If English is not your first language, you're going to be like, English drives me nuts. This is a Wyoming Close LLC, meaning the members are close. They're related. They're family members. They're friends. They're business partners, whatever it is. This is not an LLC that says, hey, we're going to have an LLC and we're going to solicit investors who do not get together at Thanksgiving. They don't take vacations together. They are not close. So a close LLC is when people are closely related. And it's a great tool for preserving assets. Wyoming law, coupled with a properly drafted operating agreement, and this is where it stops being a do-it-yourself project. There's an open secret with lawyers. It's really easy to form an LLC. You go online, you Google Wyoming Secretary of State, click, 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 poof, you have your LLC. It's all the other stuff you have to do, right? It's the operating agreement. So there is no separate close LLC type of LLC that you create in Wyoming. It's a Wyoming LLC. It's all the stuff that you need is in the operating agreement. So the operating agreement is kind of like the bylaws to a corporation. It's really how the internal workings of the LLC work. And this is really, really important because the poison pill is what is called the charging order. And this is charging order protection. So in law, we talk about charging orders and charging order protection in the sense that Owen has charging order protection. So a charging order is a court-authorized lien that is placed on distributions made from a business or in an LLC in this case. That allows a creditor to garnish distributions, meaning they can seize the shares and then they get distributions. And this is used by creditors against LLCs and limited partnerships. Here's the problem. The sole remedy that the creditor, this is a problem for the creditor. The sole remedy that the creditor has is the charging order. They cannot join the management, dissolve the LLC. They can't participate in any decisions about distributions. So what ends up happening is they say, fine, the creditor ended up with some shares of the LLC. We're not making any distributions. We'll give the creditor a K-1 translation tax bill, right? So let's say the profits for that particular creditor were $100,000. They're not going to get $100,000. That money stays in the LLC, but they get a tax bill for $100,000. That's why I call it a poison pill. And what you will find is if this structure is in place, your negotiation position is greatly enhanced. And many times these cases settle, I wouldn't say for pennies on the dollar, but they settle for a much less amount. So here's the structure. And you might remember this from a few slides ago, where we had the S Corp that's operating the McDonald's, and then the LLC that owns the shares of the LLC. Slight difference. It used to be that Owen owned everything. Well, now a Wyoming LLC owns the shares of the S Corp, and Owen's Wyoming LLC owns the shares of 123 Main Street LLC. Owen gets a distribution from the Wyoming holding company. So he's still getting $900,000 distribution. He's still making $100,000 salary, but these assets are not available to outside creditors. And this is really important. Outside creditors, what we're talking about here. So Owen gets in a car accident, not related to any operation of the business. He's on vacation and gets in a car accident, and there's not enough insurance coverage. The idea here is not only is he saving taxes, but he's protecting his assets. So his charging order protection serves to ward off outside creditors. again, greatly enhances his chance to settle. You need to remain solvent. So this is why this and the private retirement plan work together often. You have to remain solvent. You cannot put every last dollar into this Wyoming LLC. And you'll see here what we had is not every last dollar is in the LLC, right? The S Corp shares, the Main Street. Owen still has other assets in addition, right? Because at 900,000, he's not spending and that it's going into savings. And so this leads us to the California private retirement plan. So California, newsflash, the most litigious state in the most litigious country in the world, in the universe, in the known universe. We don't know of any life beyond, in all of the universe, it's the most litigious location, okay? In 1970, this is under the Code of Civil Procedure. 1970, the state legislature said, hey, you know what? If you're a California resident, you should be able to designate assets as retirement assets and have those protected from creditors. And that does exist. But you have to do it correctly and appropriately. And there are third-party administrators and third-party companies that help set people up with these. So it is not an ERISA plan. An ERISA plan is a 401k. So you do have creditor protection, but you don't have the added tax benefit. So it's tax neutral. It's not a 401k, not a 403b, not a TSA. Too often, in my view, people are sued after their business is sold. So a lot of times people will have that liquidity event. They'll sell their business. There might be a holdback and there might be litigation. You know, the buyer gets buyer's remorse and they say, you know, I wrote you a check for 10 million bucks. I want 5 million of it back. Well, if it's in a California private retirement plan, that's going to give you a layer of protection on that. So those assets, they're part in a California private PRP means private retirement plan. Those are shielded from creditors. You still have to pay the taxes. This is, again, it's tax neutral, but there are no IRS annual filings. There are no requirements to include employees. So remember with the cash balance pension plan, you needed to include employees. You don't have to include employees here. And there's no restrictions on your investment. So remember I mentioned with the cash balance pension plan, you can only have certain things in there and they have to have a certain return. With the California private retirement plan, it is free from those restrictions. So get your A team, okay? Get your A team together because your A team is going to help you with this, not a do-it-yourself project. This brings us to the end of the materials, and go ahead and check out our website. We've got a lot of blogs on there and talking about like IRAs and business succession, a lot of great content on our website. I encourage you to take a look at that. You can also buy my book through our website, Savvy Estate Planning. That gets you prepared to go, you know, whether you come to see us or another lawyer, people buy these all over the country. And I get feedback from other lawyers. They go, wow, Jim, that was a really good book because you just told stories and people, you know, you got the clients thinking about all the stuff that I'm going to ask them. So it makes the process more pleasant. Here's our YouTube page. I would really encourage you to check out our YouTube page. Go ahead and subscribe to our YouTube page and also click the share button, right? And also the notification, the little bell. So when we have content that comes out weekly, you're going to see that. And if you'd like to schedule a time to meet with us, you can go ahead to our website and schedule a free call and review us on Google. We love Google reviews. So let's open it up for questions. I'm going to go through the materials here, and if you want to put in a question, go ahead and put that in the Q&A. Anonymous asks, if you are the only owner of a C corporation, will it count for the solo 401k? Sure. Something to remember is 401ks. If you work here and you work there and you work there, let's say you have 3 jobs, the most you can put away is 61,000, right? So you can't put out any more than that. That goes per individual taxpayer. Is the cash balance pension plan the same as a 412I plan? You know, I'm not sure. I would have to Google that. Honestly, I don't have an answer right off the top of my head. Of the 245 in the cash balance pension plan, how much can be for the Roth IRA? I don't think you can do a Roth IRA. That's a good question. I don't know the answer to that question. So if anyone else has an answer to that question, if you have any advisors on here, just go ahead and put that in the Q&A. But I don't think that's an IRA, but a great question. Is there a plan outside California similar to the California retirement plan? I don't believe so. So that is, we just posted a blog post why it might make sense to retire in California. And believe it or not, there are a lot of reasons why you might want to retire in California. And we have a whole blog post on that. So is the LLC in Wyoming the same as an LLC in Delaware? Yeah, so an LLC is a limited liability company. Every state has them. Every state's legislatures authorized them. It's going to be not the same as Delaware. In our research, and if you kind of Google this, Delaware versus Wyoming Close LLC, many of the commentators put the Wyoming Close LLC as number one. Delaware is certainly in the top three, but for our purposes here for asset protection, Wyoming really stands out. Will there be protection for the LLC when you put it in the revocable trust of the parent for the kids later? So will there be protection for the LLC when you put it in the revocable trust of the parent for the kids later? Yes, because you are containing that liability in that LLC. So if the parents own the shares of the LLC, then the parents die, and those shares of the LLC pass to the kids, that LLC just, goes to the kids because now they have the shares. So I would say yes, given that they're no different. So besides Trust CFO, who else offers California private retirement plan? Trust CFO is the best, and we have a link on our website to them, but they're definitely the go-to people. They're based in Roseville. Mon asks, does a Wyoming charge an annual fee on the value of property owned by an LLC? Mon, very, very good question. If you are not doing business in Wyoming, meaning it's a holding company, and the example I went through, that Wyoming LLC was a holding company. It is not, it is not engaged in growing hay in Wyoming and employing people. There is an annual fee. It's very small, but there's no tax associated with it. So I see, answered that. Anonymous asks, if you have a business but have 2 employees, what is the best option next after a solo 401k? Anonymous, that's a really good question. If you're in California, I think if you have 2 employees, you're not required to have a retirement account, but I would talk, it might make sense to do a 401k. Now there's a care and feeding associated with the 401k, their annual expenses, but I would still look at it. It may be, there may be another entity that you can form perhaps, but that's something that certainly we could talk about, and you would just give us a call and we could discuss that. With the solo 401k, 61,000, how much can be for Roth IRA? If so, Roth IRA amount has to be after tax of 61,000. That is correct. That is correct. So those are after tax dollars. Who would set up for a solo 401k? Boy, that's a great question. That's going to be most likely a plan administrator. I frankly don't see a whole lot of them. We deal mostly with business owners, with employees. But that brings us to the end of our time here together. If you have any other questions, feel free to go ahead and you can put those in the chat in YouTube, and we will endeavor to answer those. But thanks for spending time with us today. Bye-bye.